One weekend, 158 years of history, and a system that nearly took the entire world down with it. On the 15th of September 2008, the world woke up to something it had never seen before. Lehman Brothers, the fourth largest investment bank in the United States, was gone. It had filed for the largest bankruptcy in American history, carrying more than $600 billion in debt. Within hours, global credit markets froze. The Dow Jones fell 500 points in a single day. Banks stopped lending to each other. Companies that had nothing to do with mortgages suddenly couldn't borrow money to meet payroll. And here's what they don't tell you. None of it was an accident. This wasn't unpredictable. It wasn't unforeseeable. It was the inevitable result of a system deliberately rewired for decades in favor of profit over stability and short-term gain over long-term survival. A system where profit was privatized and risk was socialized, where the people making the bets never had to cover the losses. Every empire falls the same way, slowly, then all at once. And this one started falling long before September 2008. Lehman Brothers was founded in 1,850 inches Montgomery, Alabama. Three brothers, Henry, Emmanuel, and Mayer, had emigrated from Bavaria, Germany, looking for opportunity in the American South. They found it in cotton. Farmers often couldn't pay in cash, so they paid in cotton. The Lehman Brothers began accepting it, trading it, financing it. They became the bridge between the plantation economy of the South and the textile mills of Europe. Over the following decades, the firm evolved, from cotton to commodity financing, from commodities to railroads, from railroads to the full machinery of American capitalism. By the early 20th century, Lehman had survived the Civil War, 2 world wars, and the Great Depression. It was conservative, discreet, respected. That reputation lasted for most of a century. Then the world changed. The 1980s didn't just change Lehman Brothers, they changed everything. Deregulation became the new religion. The Glass-Steagall Act, which had separated commercial banking from investment banking since the 1930s, was slowly dismantled. By 1999, it was gone. Debt was no longer something to avoid. It was the tool. Borrow cheap, buy big, ride the wave, collect the bonus. Wall Street stopped asking, does this create value, and started asking, can we sell it? By the early 2000s, the system had produced its ultimate innovation. Mortgage-backed securities. Bundle thousands of home loans into one product. Get them rated AAA. Sell them to pension funds and insurance companies as safe investments. That was the theory. In practice, banks were handing out mortgages to anyone who could sign a form. No income verification, no employment check. It didn't matter because the bank wasn't holding the loan. It was bundling it, rating it, and selling it to someone who trusted the rating. The risk didn't disappear. It was hidden, distributed across the global financial system like a slow-acting poison. Lehman wasn't just a participant in this system. It was one of its architects. By 2007, Lehman held over $600 billion in assets, but only $22 billion in actual equity. A leverage ratio of nearly 30 to 1. For every dollar the firm actually owned, it had borrowed 30. A 3% decline in asset values would wipe out everything. That's not a bank. That's a controlled demolition, waiting for a spark. At the center of all of this was Richard Fuld. Fuld had spent his entire career at Lehman. He was aggressive, combative, and completely convinced of his own judgment. Under his leadership, the firm's leverage grew. Its real estate exposure grew. Its confidence grew. Between 2000 and 2008, he earned approximately $480 million. Not because the firm was healthy, but because the system rewarded short-term performance and punished caution. When analysts warned about the housing market, he dismissed them. When Bear Stearns collapsed in March 2008, he told investors Lehman was different, stronger, safe. He believed it. That may have been the most dangerous thing of all. By summer 2008, the housing market was in freefall. Mortgage securities were losing value by the hour. Lehman's stock had fallen from $86 a share to below $10. Fuld searched desperately for a lifeline. Talks with the Korean Development Bank collapsed. Bank of America chose Merrill Lynch instead. On the weekend of September 12, government officials gathered at the New York Federal Reserve for a last-minute deal. Barclays expressed interest, but British regulators refused to guarantee Lehman's losses without a process that would take weeks the firm didn't have. No buyer emerged. Treasury Secretary Henry Paulson, former CEO of Goldman Sachs, made the decision. No government bailout. The argument, moral hazard. If you rescue every reckless firm, firms never stop being reckless. It was a principled argument. It was also catastrophically wrong. At 1:45 inches the morning on September 15, Lehman Brothers filed for bankruptcy. What happened next was not a contained crisis. It was a detonation. Global credit froze overnight. Banks stopped trusting each other. Trillions in short-term loans vanished. Money market funds marketed as essentially risk-free began to break. When even the safest corners of the system started cracking, the panic went mainstream. And then came the moment that defined everything that followed. After letting Lehman fail in the name of principle, in the name of moral hazard, the government turned around and rescued everyone else. AIG received $182 billion. Goldman Sachs and Morgan Stanley were reclassified as bank holding companies overnight. Citigroup and Bank of America received billions in capital injections and asset guarantees. It wasn't about principle. It was about connections, about power, about who mattered and who didn't. Over 10 million Americans lost their homes, 8 million lost their jobs, trillions in retirement savings and household wealth were wiped out. Dick Fuld testified before Congress. He blamed short sellers. He blamed rumors. He faced no criminal charges. He walked free. Not a single senior Wall Street executive went to prison. The Federal Reserve injected over $16 trillion into the financial system. Wall Street called it saving the system. What they actually saved was themselves. After 2008, central banks became the permanent life support of the global economy. Interest rates dropped to zero and stayed there for over a decade. The stock market tripled. Billionaire wealth doubled, then doubled again. Meanwhile, wage growth remained historically weak. Household debt climbed back toward record levels. The cost of housing became disconnected from the incomes of the people who needed it. The recovery was real, but it was not evenly distributed, not even close. And the underlying structure that made 2008 possible was never fundamentally changed. The banks got bigger. The leverage came back. The incentives that rewarded risk-taking at the expense of stability remained exactly in place. Lehman Brothers was supposed to be the warning, the reckoning that would force real reform. Instead, it became proof of a different lesson. The system will not be allowed to fail. And if you are large enough and connected enough, neither will you. Lehman Brothers didn't just collapse. It revealed the architecture of a system that most people never get to see clearly. It showed how risk is manufactured, distributed, and ultimately dumped on the public. It showed how accountability works, which is to say, how it doesn't. Global debt has now surpassed $300 trillion. The same patterns, leverage, speculation, the systematic mispricing of risk are present in every major asset class today. Every rescue creates the conditions for the next crisis. Every bailout confirms that the cost of failure will be shared, but the rewards of risk will not be. That is the real legacy of Lehman Brothers. Not the bankruptcy, not the panic, not the number. The legacy is the lesson the system chose not to learn. If this gave you a new perspective on how the world actually works, subscribe. New videos every week, because understanding the past is the only way to see what's coming next.